Money at Work continuing education series. Today's installment and today's episode centers around the three types of people that the market continues to punish time and time again. This is important and relative information right now and timely information because we have the stock market indices as well as other asset classes reaching all-time highs. So who are the three types of people that the market continues to punish? Well, first of all, it's the greedy. Most people want to get rich as quickly as possible, and bull markets invite us to try to do that. The internet boom of the late 1990s is a perfect example. At that time, it seemed like all an advisor had to do was pitch in an investment with a .com or a website associated with it, and investors leaped at the opportunity. Accumulation of internet-related stocks, many of them barely startups, reached a fevered pitch at that time. Investors got exceedingly greedy, fueling ever more buying and bidding prices up to excessive levels. Like many other asset bubbles in history, that bubble eventually burst, and that depressed stock market prices from the year 2000 to 2002. When people are overtaken by the power of greed that becomes rampant in any market, overreactions can take place, and that will distort prices. On the side of greed, asset bubbles can inflate well beyond fundamentals. When the bubble does burst and investors, traders, and speculators all hit the exits at the same time, you have what's called waterfall declines, which equal huge losses. Second type of person, the over-leveraged. Leverage is a trading mechanism where investors and traders can use to increase their exposure to the market by allowing them to pay less than the full amount for the investment. Consequently, using leverage in a stock transaction, that allows a trader to take a greater position of stock without having to pay the full purchase price. Leverage is the use of borrowed funds to increase one's trading position beyond what would be available from just a cash balance alone. Leverage, however, can amplify both the profit side as well as losses. The misuse of leverage is the single biggest killer of traders, investors, and speculators. It's intoxicating. It plays to the mirage that you can be a millionaire in a month if you use it, and it's always readily available. However, it's also the single fastest killer of accounts, and so it makes to the list of those who the market continuously punishes. And last is the overconfident. Overconfidence leads to the increased trading activity, higher risk taking, and less diversification. Overconfidence is particularly dangerous to investors because it can lead to not only excessive trading, but also a failure to diversify and sufficiently to minimize the risks. In investing, overconfidence often leads people to overestimate their understanding of financial markets or specific investments and disregard all other data or expert advice that doesn't fit into their narrative. Overconfident investors who believe that their exceptional skill and market timing and stock selection will lead to consistent, exceptional performance typically underperform the market over a long term. Overconfidence creates a vicious cycle in which investors buy when they feel confident, sell when they get scared, miss the recovery, and jump back in when the markets feel safe. Bottom line here is that you are the final decision maker for your portfolio, and thus you are responsible for any gains or losses in your investments. Sticking to sound investment decisions while controlling your emotions, whether they be greed-based or fear-based, and not blindly following market sentiment, is crucial to successful investing and maintaining your long-term strategy. You want more advice on personal finance, investment, money? MillionaireMindset.life. Stretch your thinking, create your vision, and achieve.